You tap buy, and the app says, filled, no commission, no fee, just a price. That's the perfect lie. Because while your account says $0 commission, a hidden multi-billion-dollar mechanism just took its cut from you. But here's the uncomfortable truth. That price was never one number. Every trade starts with two prices: what buyers will pay and what sellers want. That gap between them is called the spread. And the spread is real money. It's the market's hidden toll booth. You don't see it, but you pay it. So the real question is, who collects that toll on your trade? Most people imagine the stock market like a big public auction. Buyers shout bids, sellers shout offers. A fair price appears in the middle. That does happen sometimes. But a lot of the time, there's a middle layer. A layer that makes trades happen instantly, even when nobody matches you right away. That layer is run by firms called market makers. A market maker is basically a professional always open shop. They are willing to buy from you or sell to you right now. They post two prices: one price to buy, the bid, and one price to sell, the ask. That's how you get instant execution without waiting for a perfect match. And the spread is how this service gets paid. Think of it like this. You walk into a currency exchange at an airport. They'll buy your dollars at one rate and sell them at a slightly worse rate. That difference is their fee. Stock trading works the same way, just faster and more automated. So spreads aren't a conspiracy, they're a business model. They exist because market makers take on risk. If they sell to you and the price jumps right after, they lose. If they buy from you and the price drops right after, they lose. So when the world feels uncertain, spreads tend to widen. When things feel calm, spreads often shrink. The toll booth charges more when the road is foggy. Now here's where it gets more interesting. Your order doesn't simply go to the market, it goes through a routing decision. Routing just means your broker chooses where to send your order. Sometimes your order goes to a public exchange. Sometimes it goes to a market maker who fills it directly. And that decision matters because money flows through it. Your broker is supposed to get you the best overall deal, not just the fastest fill. The best combination of price, speed, and likelihood of getting filled. That idea is called best execution. Simple meaning, your broker should try to get you the best outcome available. But brokers are businesses too. And one way some brokers make money is through something called payment for order flow. That sounds complex, so here's the simple version. A market maker may pay a broker to send customer orders to them. Why would a market maker pay for your tiny trade? Because tiny trades in huge volume are extremely valuable. Retail orders often behave differently than professional trading. They can be easier to price and safer to trade against at scale. So, if a market maker can win the right to execute millions of retail orders, they can earn tiny slices of the spread over and over again. This is how free trading can exist. The broker doesn't charge you a commission. Instead, the broker gets paid by the market maker for the order flow. The cost doesn't disappear. It changes form. It becomes less visible. Now we need one more important word: internalization. It sounds technical, but it's simple. Internalization means your trade happens inside a market maker's system. Instead of being matched on a public exchange, you still get a fill, you still see a price. Everything looks normal, but your order might not have interacted with the public order book at all. It was handled privately behind the scenes. This isn't automatically bad. In fact, market makers often promise something called price improvement. That means you get a slightly better price than the best public quote. Example: if the best public sell price is $10, a market maker might fill you at $9.999. It's tiny, you barely notice. But scaled across millions of trades, that becomes a serious advantage. That's why brokers and market makers advertise it. So where's the problem? The problem is proving what would have happened otherwise. Because the real question isn't, did I get a tiny improvement compared to the public price? The real question is, would I have gotten an even better outcome somewhere else? That's the difficult part. You can't answer it by looking at one trade. You need a scoreboard for execution quality. That's why regulators and market rules push for reporting and disclosure. In plain English, show where orders go and how good the outcomes are. How fast were fills? How often did customers get price improvement? What was the real cost of the spread in practice? Because in a world of free trading, the biggest cost is often not a visible fee. It's the invisible cost inside the execution process. And here's why this gets confusing for regular people. We're trained to look for bills. If something has no fee, we assume it's free. But spreads don't look like bills. They look like normal pricing. The system doesn't charge you at checkout, it charges you in the difference between buy and sell. It's like a store that removes the checkout fee, but slightly increases the price of every product. You feel like you saved money, but the payment still happens, just differently. Now zoom out to the system level effect. If more retail orders are internalized, fewer orders may hit the public exchanges. That can reduce how much trading happens in the open. And the more trading happens privately, the more price formation depends on a smaller number of huge intermediaries. The market doesn't become fake. It becomes more mediated, more filtered through toll booths. This is why different regions regulate this differently. Some markets say, allow these practices but measure them, enforce best execution and disclosure. Other markets focus on the conflict itself. Should brokers be paid for routing at all? Even if customers often get good fills? Same machine, different rules, different answers to the same trade-off. And no rule removes the basic reality: liquidity has to be funded somehow. Liquidity just means how easily you can buy or sell without chaos. When you tap buy, liquidity is what makes it actually happen right now. Market makers provide that immediacy. And immediacy has a cost. Remove payment for order flow, and brokers may bring back visible commissions or other charges. Allow it, and you must police a more hidden form of payment. Either way, the market is not free. It is financed. The only question is where the bill shows up. Here's the mental model that makes all this simpler. The market is a factory that produces instant trades. Market makers are the factory floor. They turn your urgency into a completed trade. Brokers are the front door. They decide where your urgency enters the system. Exchanges are the public showroom. Orders compete in the open, and regulators are the inspectors. They try to keep incentives from quietly breaking trust. In that factory, the spread is like the electricity bill. Everybody pays a tiny piece of it, because electricity is what keeps the whole factory running. This is why price charts are the wrong place to understand how markets work. Charts show outcomes, but the real story is in the plumbing: spreads, routing, incentives, and execution. And here's the final twist. Market makers don't need you to be wrong to make money. They make money when you need immediacy. The toll booth charges you for crossing, not for losing. So when someone says, "I trade for free," what they often mean is, "I can't see the bill," and most people only notice the bill when the market gets stressed. Because in calm times, spreads feel tiny, but in chaos, spreads widen. The toll booth suddenly becomes visible. If the price you pay is shaped by a chain of intermediaries, then the most important financial skill isn't predicting the next move. It's understanding the chain, because once you see the chain, you stop asking, "Where will the market go next?" And you start asking the question that actually runs everything: who gets paid and why? When it comes to free trading, the real experts don't predict the market. They predict the money flow. And now you know how to see the chain.